Hey folks, and welcome to the Pipnotic Symposium on the 5th of November 2025. Today we're going to talk about developing algorithms. We're going to start by discussing a hypothesis that I have about the markets. I have many, but we're going to focus on one in particular. And then we are going to develop this algorithm, back-test it, and then put it on an account so that we can see it live and breathe. And the results of this development process will be made available in the members section, so you guys can all get access to this algo. But first of all, let's talk about a few different things. When you develop algorithms, you can do so based on a few different things. Number one is you have to decide if you are going to take a concept or an idea or a theory, and you're going to develop an algo based on that theory and then test it on data. And this is called idea first. Idea first. And this is how a lot of people operate, but others do something differently, and this is called data first. You can maybe guess what that means, but essentially what it means is that you let the data, you interrogate the data until it speaks, until it tells you its secrets. Because I think if you take data and you interrogate it to a very high degree, then over time, if the data size or the data sample is big enough, then it will start to present, or rather the analysis result will start to show you what rules the data operates under. And this can be something as trivial as if the first two bars of the London Open, so let's say London Open, the first two bars are up, 2 times up bars, or then you sell them. Prices often go down thereafter. You say you have the Open of London just here. You have 2 bars, if they're both bullish bars. This is just an example. This is not real. Then normally when this happens, when you observe 2 bars, 1, 2 at the London Open, the next bar is generally bearish. So this could be something that you would consider to be a data first algorithm, okay, where you focus on the data, you look at the data, either manually or using automation, using code like Python or MT4, MQL, and by observing the data, watching the data, this pattern seems to come out. This could be one example. And then you can have idea first, and you can say, this is a real idea, and that is when you have, let's say this is the Asian session. I'm just going to put A in here. This is actually a real thing that I've observed, and I think it's a very common observation, I think, where if the Asian session trades higher during the London Open, if prices go up outside the range and close within, then the European session normally trades down. Likewise, if you have the Asian session here and prices trade down during the London, they go out, they kind of pick up some liquidity here and close back in, then the European session trades higher. Okay, this is a very common observation. So we could make algorithms based on this, or based on this, or something entirely different. And we're going to do something that's super simple that we can test. And this algorithm is based on the behavior of trends and when trends start. And so the next question could be, what is a trend? What is a trend? What is a trend? Well, a trend is simply a directional movement in price. So prices can go up over time, or they can go down. But how do you quantify a trend? What can you do in order to look at the trend? Of course, you can look at it and you can say, yes, prices are going up, or prices are going down, or prices are doing neither of the two. Or you can do something like you can take a moving average, and that moving average is, let's say if you have let's say, a few different data points where you have like 1, 2, 4, 3, 1, and you take them and you add them together and you say 4, 5, 6, 7, 8, 9, 10, 11. This is 11, and then you divide that by the number 1, 2, 3, 4, 5. Okay, that's going to be about, what was it, 2.2ish? That's the average. Well, I think that was just a quick calculation, but that's the average there. Okay, so the average of all of these is 2.2. And so if you have, for example, a moving average, and you have 1 point of a moving average, this point of moving average is looking at 5 data points. This one and the 4 previous, like so. Okay, and that gives us a value which could be 2.2, for example. Okay, and then the next one, this can do the same. We get another 5 value average, and you look at this one, plus this one, plus this one, plus this one, plus this one, divided by 2, and that could be maybe 2.3. And the next one could be 2.5. Okay, and you can see that these values are slowly going up. And the good thing about using moving averages is that they give you, like, the data is normalized in the way that it just smooths out the direction of this moving average line. And the reason it does this is because you take an average. Okay, you don't have any outliers. So if you had 1, 2, 4, 11, 2, well, then the result would be quite different. Of course, this number would be bigger, but it would not be 11. Okay, so these numbers here together would bring the value of 11 down, but the value of 11 combined with these, the average would bring these 4 other numbers higher, and so it would just be kind of somewhere in between. Okay, and you have something like exponential moving averages where the most recent data points, so these here, they are weighted heavier than the historical data points, because historical data points have already happened. The most recent data points, they contain things like sentiment and stuff like this. And so an exponential moving average, called an EMA, you weight data based on its novelty. Or you have a simple moving average, an SMA, and this simply takes all of the data points and it weights them equally, just like we did in this example, and this example, and this example that we'll do over here. Okay, and so defining a trend, let me remove some of these. So defining a trend would be simple as, more or less, looking at a moving average. But the problem with the moving average is, does a moving average tell you when a trend is born, or does it tell you when a trend is established? Well, it tells you when a trend is established, which is a problem in many cases, because when prices go up, if you have a moving average that's going up, when you can see, yes, we're going up, for example here, we can see, yes, this data point is greater than this data point. Or maybe you take stock a little bit later in the trend and you say, yes, this data point is greater than this data point. Typically what will happen when you get the signal to buy, let's say here, what happens? Prices often go around, because normally if this is like a 1 period moving average or just a line chart, prices are going like this. And then normally when prices reach a high and the moving average is caught up, then they start to go down like this. And so it's quite difficult to get right. It's actually very difficult to get right. And so what you need to do is you need to do something else. And you can do a few different things. You can look at something like, if you have a moving average like this, these are just bars. You can look at the bars here, and you can count the number of, like, the close values of these bars here, and you can say, well, the most recent 50%, which is these ones here, are these above or are they below this moving average? Okay, and that's not a very good example because you can't see, but if we go like this, okay, you can say, actually, the most recent ones, which are these are actually above, so these are positive, and these are negative. Okay, and so what you can see here is you can, if you have a downward trend, this is the moving average, prices go up. What you do when you quantify the beginning of a trend like this, you can actually see when prices turned negative and they started to get positive. Then you get in pretty early on in that trend, not when the trend is already established. Okay, and so doing that enables you, it's not perfect, but this is just an example, but it tells us, enables us to assess whether we have prices that are moving above the moving average, which will draw the moving average higher, which essentially is telling us that we have the very beginning or the birth of this trend. Okay, and this is a whole thing, this is a whole concept behind moving average crossover, where you have like a moving average that goes like that, and this is a slow one, then you have maybe a slow one, this is the fast one, sorry, and the slow one is maybe a bit like this, it goes like that. It's much slower, but you can see that the actual crossover happened here, and it happened here as well. So we got the signals that prices are going higher before we got positive readings on this slow moving average, which was probably around just here. So we got a signal here, 1, and we got a signal here, 2, which says that we could potentially buy here, or we could buy here. Okay. And so looking at moving average crossovers can be a pretty decent way to tell you when we have the beginning of a trend, because you have the slow one that moves very slowly, but the fast one is reacting quicker, and it does something like this. And so we would get the crossover here in contrast to later, let's say here for the sake of example. So you got in a little bit earlier. So what we're going to do is we're going to try and look for the beginning of a trend based on this. And then we're going to look at some simple statistical, mathematical models, simple ones, in order to assess, take samples of data, pieces of data here we want to look at a little bit more data here, then we want to look at like a bunch more data over here, or you have the smaller one over here, where we look at a little bit of data here, a little bit more data here, and then a lot of data here, and we look at the behavior of prices during these windows, these samples of data, and we use that to tell us if prices are showing the characteristics of a bullish trend or a bearish trend, or neither. And we're going to look at something called the Hurst exponent, which is a very interesting way to do this. And so typically you have like the Hurst exponent, which is typically represented by H. Okay, and then what you do is the result of H is typically equal to a value, a 0 point something. So it could be a 0.5, for example, or it can be 0.2, or it can be 0.9, for example. And essentially what this means is if we're hovering around 0.5, well then the data samples taken, let's say we're looking at maybe 3 different blocks, they are exhibiting something similar to Brownian motion, which is essentially just a random walk, where prices are neither going up nor going down. They're just kind of moving around like that, for example. And Brownian motion is actually a model that was created by a biologist. I believe this individual was a biologist, about how particles of pollen react when they're suspended on the surface of a liquid, and I made a video about that a little while ago. But what we can do using the Hurst exponent is that we can look for values that are, for example, above 0.6 or below 0.3, for example, or 0.4. Okay, and everything in the middle, we do nothing. We do absolutely nothing. We wait until prices show us that they are moving higher, or if they are moving lower. Okay, so this is what we will base all of this on. Okay, so if I go back, let me just clear this all off. If we go back and we say, number 1, we're going to use moving averages to find the beginning of a trend, beginning of trend. And we're going to look at Hurst exponent to tell us a little bit about kind kind of the behavior, which is, we'll use this is also a trend. Okay, so we're going to look at where we are in the trend. We want to be close to the beginning of it. And we're going to look at the Hurst exponent to tell us when we are starting to expand positively or negatively. Okay, so we're going to use these two rules for our entry signal. And for risk management, we're going to use like ATR, just to keep it super simple. ATR multipliers, let's say 2.0. So this will be our stop loss, and then we're going to have a target multiplier, which is going to be the stop loss modified by multiply. Okay, so if you look at these two here, 2 times ATR, that's going to be the equivalent of 1R, and if we consider that 2 times the stop loss, that's 2R. That's going to be our profit. So we're going to have a 2R, which is an average winner to loser, that is, or risk reward is going to be 1 to 2. Okay, so we're going to have our winners are going to be 2 times the size of our losers. Okay, and then we're going to go one step further, and we're going to look at stop losses. Okay, we're going to put trailing stops plus break-even stops. Okay, so this is going to be the foundation of this algorithm that we are going to make. And I'm going to stop now. That's 16 minutes. So just like chew on this for a little while, and then maybe the next day or two, then I'm going to continue on, and then we'll start coding this algo, and then we'll continue with the process. Okay, but I hope this is interesting. If you have any questions, please do let me know. And once again, thanks so much for watching.